What's up, everybody? Welcome to Midwest Sagacity. Thanks for stopping by. I'm Midwest Savage, and today we're going to go ahead and take a look at what's going on with the banks and their activities behind the scenes versus what Janet Yellen is saying out there. She is saying that she expects some moderate growth this year. However, they also said that they're expecting a mild recession. Now, I don't know how you can have moderate growth and a mild recession all in the same year, especially when they said the recession's going to take about 2 years to recover from. But we're going to see if we can't untangle that double speak and see what's really going on and what are the indicators and what the future's looking like. With that in mind, let's get into it.
At least 6 shots from inside the building.
I mean, what do we got to do?
Parties are running out.
What is it that we can say to get people to wake up?
I'd like to begin today by updating you on our efforts to recover the debris. China has a high-altitude balloon program for intelligence. The president also instructed the intelligence community to take a broad look at the phenomenon of unidentified aerial objects.
FEMA is now sending a team to East Palestine, Ohio, and this comes more than 2 weeks after the train derailment threatened.
Reminds me of stuff that just happens at work. Just one person after another not doing their damn job, and everything would be okay if everyone just did their damn job. All right, guys, let's go ahead and jump into this first article. This is from CNBC, and it was published this last Saturday, April 15th. And title is Yellen says U.S. banks may tighten lending and negate need for more Fed rate hikes. Now, if you remember in the last video, what that guy was saying, he was saying that they were probably more than likely going to have to do some sort of emergency cuts to the interest rates, just due to the fact that all the indicators show that there is a recession coming. So that's interesting that not long after I post that video, Yellen says banks might tighten lending rates and they might not even need to do any more rate hikes. In fact, they'll probably end up doing cuts. Let's get into the article. U.S. Treasury Secretary Janet Yellen said banks are likely to become more cautious and might tighten lending further in the wake of recent bank failures, possibly negating the need for further Federal Reserve interest rate hikes. Yellen said in a CNN Fareed Zakaria GPS interview that policy actions to stem the systemic threat caused by last month's failures of Silicon Valley Bank and Signature Bank had caused deposit outflows to stabilize. And things have been calm, according to the transcript that was released on Saturday. Goes on to say banks are likely to become somewhat more cautious in this environment. We already saw some tightening of lending standards in the banking system prior to that episode, and there may be some more to come. She said that would lead to a restriction in credit in the economy, which we've already seen. If you look at the M2 money supply, it's been actually negative, which is not a good sign. It's like the guy said the last time, it's only happened 5 times, including the great financial crisis. There's just a few instances this has happened, and every time it's been pretty bad. But she said it could be a substitute for further interest rate hikes that the feds would need to make. So basically she's saying that they might not need to do any rate hikes just due to the economy and the banks contracting their own credit, which means the inflation is going to go down. Dramatic enough, or Yellen said she was not seeing anything as of yet that was dramatic or significant enough right now to alter her economic outlook. And she quote, "So I think the outlook remains one for moderate growth and a continued strong labor market with inflation coming down." Now that's interesting because a few days before that, the Fed said that there was going to be a mild recession. And on top of that, we were going to, it's going to take about 2 years for it to return. So I don't know how she sees moderate growth. Now, here is an article from Forbes. Interest rates in 2023 A recession could force the Fed to cut. Now, this is exactly what the other guy was saying. They're going to probably end up having to do an emergency rate cut simply because we're going to go into a recession. The Federal Reserve right now is saying that they don't plan on making any cuts. If the data comes in that they have curbed inflation, then they may do a cut, but they don't plan on it right now. Now, this article says the Federal Reserve will meet to set up short-term interest rates on May 3rd. Wall Street sees a balanced chance of Fed either making a 0.25 percentage point hike or holding rates steady, and the Feds wouldn't likely disagree with that assessment, but leaders are waiting to assess the incoming data. But the bigger question is what happens for the remainder of 2023? The Fed expects to hold rates at elevated levels for the rest of the year. That is their current policy right now, but I don't think it'll happen. And here's why. Markets are estimating the Feds will actually cut rates by September based on economic weakness. And right now, they're trying to say that they're not seeing any economic weakness, which is kind of ridiculous, as if loans and credit is contracting and people have less money to go buy things, that to me would indicate a economic weakness. Now, if they're basing the data on the stock market, well, that's all been inflated. Now, here goes on to talk about the recession signals. So far, the big factor is likely to drive interest rates for 2023, whether we see a U.S. recession. Certain indicators imply that one is on the horizon. The yield curve is inverted, and an indicator that has historically forecast recessions with some accuracy. Home prices are also softening, and housing is likely a key swing sector for the economy. That's right. Home prices are dropping. Rent is also dropping. However, for some reason, my landlord seems to want to raise the rent. I don't know how he's going to do that when the economy is dropping. But in contrast, unemployment is at very low levels, implying there is no recession. See, that's the indicator that the feds are going by. Unemployment's low, so there's no recession. But that they got to look at more than that, because even though people are employed, I mean, even at my job, we're having a hard time getting supplies and things like that. There's a lot of product we have to take off the market because we can't get supplies for it. Thus, switching to making a more expensive product, which means less people are going to be able to buy it. The unemployment rate did edge up in February to 3.6%. So they are starting to see a climb in unemployment. And this is due to corporate layoffs. And this was especially in the tech sector. This is because they were hit the hardest by Silicon Valley Bank failing. And a lot of tech companies were hit because of that. All right, we're going to go ahead and go to the chart posted by Economic Research from the St. Louis Fed. And this chart is going to show us the net percentage of domestic banks tightening standards for commercial and industrial loans to large and middle market firms. Now, if we look at these peaks, let's take a look at some of these peaks here. This one, 2001, I'm assuming that's the dot-com bubble after 9/11. We saw 59.6% of the banks tightening up their standards for lending. The next peak is going to be Q4 of 2008. Now, there was 83.6% of the banks that were tightening up their lending standards during that time. And as we all know, that was the last time we had the Great Recession. And then the next time was in Q3 of 2020, and this is when all the banks were expecting everything to remain closed and people were starting to default on loans, so they started tightening up their standards. There were 71.2% of the banks, and that would have probably went higher, but the Fed stepped in, and that's when the stimulus money and everything came out. And then where we're at today, Q1 2023, 44.8% of the banks are tightening up their lending standards. And this is just the beginning of the rise. It's continuing to go up, and I don't see any reason for this to go down. In fact, I think we're going to shoot past Q3 2020 and possibly even get past 2008, which was probably one of the highest at 83.6% of the banks tightening up all their lending standards. Now let's go over to this article that was written by Cox Automotive, and it was Monday, April 10th, 2023. So auto credit availability has shifted in March, impacted by the banking crisis. So as we scroll down here, we can see that in 2020 and about that July, August range, that's when the banks started tightening up. If you remember the peak in 2020 of that last chart, that was right here in this area. And that's when the availability of credit went down considerably. Then everything went up pretty high up here. And if you notice a trend, it goes up, peaks, and then comes back down pretty hard and pretty quick. And so we got up here in July 2022, and then ever since then, we've been on a downward trend. Now, in March, it went slightly up, but I don't think that's going to be breaking the trend. It's probably going to continue down, especially since the Fed said we need to prepare for a mild recession. So how does the credit availability affect everyone if they are tightening up their standards on loaning to businesses? Well, that always trickles down to personal loans as well. But here is another example right here. U.S. lender Citizens stepping back from auto loans, says the CEO. This was New York, January 30th. U.S. lender Citizens Financial Group cut back on auto lending last year and plans to further reduce its exposure to the segment as it becomes cautious on certain businesses as it factors in risk of a recession, its chief executive officer said in an interview. Basically, what they are saying here, they are expecting a massive decline in the automotive business, as well as anyone taking out a loan currently will more than likely default on those loans, so they don't want to risk it. Moody's Investors Service late last year cut the outlook for U.S. auto financing arms to negative, citing likelihood of higher delinquency and provisioning. Article goes on to say Citizens has reduced its auto loan portfolio by about $10 billion as of now, from a peak of $14.5 billion in December 2021. Bruce Von Son recently told Reuters. That's a cut of nearly $5 billion. We basically made a decision to move that portfolio down materially over time. Said the spreads are tight, so you're not making good return on that capital, and that's because the interest rates were so low. So if you got a loan at 3%, they weren't making that much money on a $30,000 loan or $40,000 loan. Now, when you got a 10% loan or something like that, you're making more money, but more likely to default as well. Spreads are tight, so you're not making a good return on that capital, he said, adding there are limited cross-selling opportunities. That means it's hard for them, if they want to, sell those loans to another bank. Von Son said it will be brought down to $5 billion to $6 billion by 2024. So they're going to reduce it by another third of what their peak portfolio was. So they're cutting it 2/3. Here's another article in Automotive News. Mechanics Bank stops taking auto loan applications, will exit the business. The bank's auto finance business planned to stop accepting loan applications after Wednesday, a spokeswoman said. This was as of February 23rd, 2023. So they are out of there. Don't think it just stops there. Here's an article from April 11th, 2023. Capital One exits floor plan lending business. The bank giant decided to exit floor plan lending on March 29th, but will stay in the auto finance business. Yes, that means even dealerships. A lot of people don't know, when you go to buy a car, all those cars that are sitting on the lot are on loan from the bank. They take those loans and buy them from the manufacturers. Once they do that and then they sell the car, then they pay the loan off to the bank, and the manufacturer also can help offset some of those interest costs. But They basically do short-term loans on each of those vehicles, and they pay interest every month on those vehicles. That's why they try to sell them as fast as they can so that they're not getting charged interest. But each dealership has to buy every vehicle from the manufacturer. So banks are leaving the dealerships because they are expecting a recession, and people aren't going to be buying cars as often in a recession like that. So they're even leaving dealerships high and dry. Here's another article from San Francisco Business Times. Big Bay Area bank slams brakes on auto lending through dealership. That's the Bank of the West. I believe that is also pulling out of auto lending. So yes, guys, the banks are leaving the dealerships, and that's a huge indicator of what they think is about to come. All right, guys, we're going to go ahead and wrap the video up there. Just wanted to do a quick video, let you guys know what's going on behind the scenes in the banking world, and let you know that there's more of this credit contraction tightening going on. So if you're in the market for a house or anything like that, might want to hold off for a little bit. Otherwise, you're going to be getting charged, if you don't have perfect credit, way higher interest rates than you normally would. And on top of that, the housing prices, they're coming down, and they're going to continue to go down. It usually takes about 5 years for the housing market to hit the bottom. So as these housing prices go down, you might want to wait until the feds cut the rates, and 3 years in probably would be the best time to buy a house. It's going to take a long time for these markets to come back down. Everything is overpriced right now, so might want to hold off a little bit. Make sure you guys go ahead, if you like the content, go ahead and hit that subscribe button. Go ahead and drop me a like. I really appreciate it. And if there's another topic that you want me to cover, go ahead and drop it in the comments. I love hearing from you guys. I respond to everyone right now because there's not a lot of you commenting. So go ahead and drop some comments down below and let me know what you think. Maybe I'm wrong. Maybe nothing will happen, but it's not looking that way. So I just want people out there to be prepared for what's to come. Thanks for stopping by. And what's it going to take for everyone to wake up? Remember, all it takes is all you got. Peace.